What we're going to be looking at here is a long-term contract where we have a loss in the current period, and we're going to look at how we record this loss. So for example here, we're going to be using the percentage of completion method here on this contract, and we can also be looking at it in terms of the completed contract method, which would be different. But let's start with this percentage of completion method here. So we have this 3-year contract here, and it starts here in 20x1, and then it would be concluded here at the end of the year here in 20x3 here, where the contract would be completed. But with this percentage of completion method here, what we're going to be looking at here is our 20x2 year here, and we're going to run into a problem here where we're going to have realize too much profit here in our first year, 20x1, and then based on that here, we're going to have a loss here, or what we're going to have a loss here on our gross profit on this contract, and how we'd handle that here. So first, let's go through our numbers here, and we'll start out here with 20x1, where the contract price here is $3,200,000. Everything is shown here in thousands of dollars, but I'll just refer to as $3,200 here. And then with the completed contract, we have the cost to date here of $800, estimated cost to complete here of $1,200. So our total cost here on the contract is $2,000. Compare that to the contract price here, $3,200. So we have a total estimated profit here of $1,200. Now, the percentage of completion. So this is the key here to this. You take the cost to date, that was that $800 here, and you divide it by the estimated cost to complete. Total estimated cost here to complete it here is $2,000. So that division gives us percentage completed to date here of 40%. This is using that percentage of completion method. So our total estimated profit here at $1,200 times the 40% gives us a total gross profit recognized here of $480. Now we hadn't any previous gross profits here, so total gross profit for the current year here is $480. Okay, so now this is where we're going to come into a problem here in year 20x2. And normally we would have budgeted this evenly here on this contract, this 3-year contract, where we wouldn't have recognized any losses. But come to year 20x2, our estimated cost to complete it here is increased over what we initially estimated. Now it's sitting here at $888, and our cost to date at this point was $1,650. So our total our cost here to date plus the estimated cost to complete it is $2,538. Compare that to the contract price here of $3,200. So we're getting a total estimated profit here of $662 on this contract. Now, here's the key here. We have to determine our percentage complete on the contract. Simply what we did previously here. You take your cost to date, $1,650, divide them by your estimated cost to complete here, $2,538. You're going to come up with 65%. So take that time, your total estimated profit here, $662, you're going to come up with a total gross profit here recognized for the period here of $430. But what we have to do is we have to subtract our previous gross profit recognized out from the current gross profit here of $430. So that was $480. We subtract that here from our $430, and you can see here we're going to have a gross profit in the current year here of a -50 here. So that's our problem here. We overallocated our what we recognize as gross profit here in this first year based on our what changed here, or our estimated cost to completion here. So what we would do here, just looking at it in these terms here, this is what we're going to have to recognize as a loss here. And we'll get into that here. But again, in 20x3, we just had our cost to date here equal our estimated total cost to complete here in 20x2. And difference here, 2538, same as our previous year here in 20x2. Compare that to the 3,200. In this case, we have 100% of the completion here. That gives us 662. And then we have to subtract out our previous gross profit here of 20x2 here of 430. So we're going to have gross profit here for the year end of the contract here in 20x3 here of 232. So you can see what's happening here. We had gross profit here in the first year here, and then we have a loss here in the second year here, and then we have gross profit in the third year that we recognized on this contract. So let's look at this loss here. Well, in terms of revenue minus expenses here, the revenue, that was that $3,200 contract price, and we would, for the current year here in 20x2, well, we had recognized 40% earlier here and 65% we calculated for the current year. So the difference here was 25% that we would have here in 20x2 times our contract price here, 3,200, gives us 800 here on this contract, the revenue that we recognize using this percentage of completion method. Now our cost incurred, that was the 1,650 here in 20x2, subtract out the 800 previously recognized here, so the difference gives us 850 to costs incurred. Compare that to our revenue, so you can see our costs here are $50 more than our revenue here. So that is the loss here in 20x2. And we'll look at how we'd record that. So again, we're going to be able to record this loss here in this current period. And we're not going to have to redo our numbers here in 20x1 because the contract is still profitable. So that's the key here. We have to look to see if the contract's still profitable here. And that is here. We still have $662,000 we're estimating on the profit of this contract. Okay, so let's go down here and just review that here. The contract is profitable in 20x2 that we just looked at. So in this case, the it would be $50,000 here, but the 50 loss here is an adjustment of the excessive gross profit recognized here in 20x1. This 480 here is an excessive amount of gross profit here that we recognize in 20x1. Instead of restating the prior period 20x1 here, we absorb the prior period we absorb that loss here of the prior period 20x1 here in the current period here 20x2. So that's the key here. If the contract's profitable, then you can absorb the loss that you have here in the current year here, 20x2. Now, if the contract was not profitable, it would require reversing this 20x1 profit here, but that isn't the case. Okay, so now let's go up and let's look at how we'd record this here. So just looking at our accounts here, when you're dealing with these long-term contracts, you have a construction and process inventory account here on the balance sheet, and that's where you accumulate all your losses, or your costs, excuse me, and any losses in this case, and also you accumulate your gross profit. And along with that here, that's on the balance sheet here as an inventory account. Then you have this revenue account here on the long-term contracts on your income statement, and then along with that you have construction expenses for that contract here on your income statement. So let's just go through it here and let's look at this loss here. So what we would do here, we'll first go through this loss here, how we record it, and then we'll go through the rest of our numbers. So this $50 or $50,000 loss here in 20x2, we would credit or we reduce our construction and process inventory account by that amount here. And then as far as our revenues here, we'll just go through the debits and balance. That was that $3,200 contract price times the 65% here that we calculated for the current year, 20x2 here, minus what we already realized here in 20x1, 40%. So the difference is going to give us 25% of that 3,200, which we went through before here is 800. So what we have here in our revenue account, we have a credit here of 800, and in our construction in process, the loss here, we also credited that here for $50. So our total credits are sitting at 850 here on, and then going just down to our construction expenses here, we're going to look at that. We would have debited that here in 20x2 here for 850. So that's how you record this loss here in the current period here, 20x2, and it was a result of over profits here in 20x1. But let's just go through our numbers here so you understand what's going on here. So first, for our construction and process account, going through our costs. So if we went up here to our chart here where we had our calculations, our costs here for the current year here were 800 for 20x, excuse me, for first year 20x1 cost to date, we would have accumulated 800, no previous costs here. And then for the year 20x2, well, we had the 1,650 minus 800 that we all recognized earlier here. That gives us 850. And then of course our loss here in 20x2 that we absorb here, and we reduce our construction and process by that amount. So our construction and process here, we're increasing it for these costs here and also for the gross profit. And then looking at our last year here, 20x3, well, we had costs here to date 2538, recognized 1650 earlier, so the difference here gives us construction and process cost account here of 888. And then looking at our gross profit here, that we could take for the first year here 480. And over here, increase that here, construction and process by that amount, and then for the last year here, 232. So that goes down, increase our construction and process account. So we've accounted for our gross profits here, but when we were able to go back and because we had a profitable contract here, still sitting on our books here in 20X2, we were able to absorb this loss here. And by doing that, we reduced our construction and process account. And then just going over to our inventory account, again, what we've done here, just so you understand what's going on, that's our contract price here, 3,200 times the 40% here in the first period here, first year, gives us 1,280. And then we went through this second period here, 3,200. That was 65% versus, and 40% already recognized for 800. And then for the last year here, just so you see what's going on, we have the total 100% here in 20X3. We already recognize 65%, so you subtract that out, and you're going to get that amount here times your contract price for 1120. Okay, so that's how we've taken care of our revenues here. We calculated our costs here, and then if we go down to our construction expenses here, again on our income statement, revenues we recognize on the income statement, and construction expenses on our income statement. That was simply what we would have accumulated in some accounts. I'm just showing them here. Revenue minus construction expenses is going to equal what our amounts are here. So our construction expenses, that was just what we had debited. Those were the 800 here for the first year, and then the second year and third year. Total amount here 2538. Okay, so that's how we handle that here with the loss. You just take and reduce your construction and process inventory account by that loss amount, because we were able to absorb the loss here of $50. So if we look at, just go down here and look at our gross profit here, revenue minus expenses. So our first year here, if we just go through the numbers, we had revenue here of 1,280, expenses here of 800, so that gave us 400 here, 480 in gross profit, which we recognized up here in our construction in process account. Next year, 800 here in our gross in our revenue here, minus our expenses here of 850, gives us that $50 loss, which we credited to reduce our construction and process account by. And then gross profit here in the last year, that was that 1,120 here, minus the cost here of 888 in that third year here for 232. So there's where we would have 232 here gross profit. That's what we recognize here for the last year in our construction and process account. So just going down here and reviewing it here, you adjust the previous gross profit. We've adjusted that previous gross profit here in 20X2. We absorbed it by absorbing the loss in the current period here. The gross profit, excuse me, we adjusted the previous gross profit here in 20X2 here by absorbing the loss in the current period here, 20X2. So, and that's only because we had a profitable contract. So, and that, had it not been profitable in 20X2, then we would have had to go and readjust that year 20X1 previous gross profit. Now, if we go here and we talk about it in this terms here, looking at the completed contract method, we went through the percentage of completion method here, but had we looked at it in the completed contract method here, you would not recognize this loss here in this 20X2, because the company is still assuming that they expect to earn a profit on the contract here at the end of the year 20X3 here. But completed contract, we wouldn't have gone and we wouldn't have had this loss here. But with the percentage of completion method, the way it works here, that's where we recognize the loss. So just going back up here again, looking at, these are the accounts we have to have. We went through them all here, but we have this construction and process inventory account on our balance sheet, and then we have the revenue here in our long-term contracts here in our income statement, and then we have our construction expenses. I went in the construction and process, accumulates all the costs on the contract, and also in this case the loss here in that second year here, and then also the gross profit. So you can see here our construction and process inventory account. Our total amounts here at the end of the contract here was that 3,200, or that was that 3,200,000 here, and that was our contract price, and that balance, or that total debit here would balance with our credits here and revenues on the long-term contract. Add everything up, you come up with 3,200. But then on our income statement, these construction expenses, that's what we calculated here off our chart, or what we had here based on the cost to date and the estimated cost to complete. And looking at the difference here between periods here, we come up with our total construction expenses here, 2,538. So if we went up to our chart, we would see that here. So our total gross profit here is simply the 3,200 here of our total revenues recognized on this contract. Subtract the reduce it here by a construction expenses of 2,538 here. You're going to come up with the gross profit that we calculated here. So if you do your arithmetic here, so just remember here, because we had a we still had profit in this contract here in year 20X2 here, we could absorb the loss here on this contract, and it gone against our construction in process inventory account. And I guess that'll discuss it here for our discussion here. So just so you understand what's going on and how you calculate your revenues here. And we did it in terms of this percentage completion method here. And just back off here one method. Had we did a completed contract method, we would have only recognized our profit here when the contract was completed. And we wouldn't have gone through, and we would have accumulated costs here on our construction and process inventory account, but we wouldn't have recognized any gross profit here as we did. And we'd only recognize any gross profit when it's completed. Therefore, we wouldn't have made any, on a completed contract method, we wouldn't have made any adjustments for losses in this current period here, 20X2, because we would still expect to earn a profit on the contract. Had things been different and we wouldn't have earned a profit on a contract, then we would handle it differently. But this is how we handle it here when we have a loss here in the current period, and we can absorb that loss. We don't go back and restate any previous periods here. We just take the loss in the current period here and make our adjustments. Okay, so that'll end our discussion here on the long-term contract where we have a loss in the current period.